Hello, fellow traders. You're looking at my chart, my E-mini futures chart, on Friday, August 4th, following the close of the market. And I want to give you a piece of advice, a piece of information in this video that you're not going to like, but the fact of the matter is you're going to have to withstand the reversals if you're going to stay in the game as a trader. You know, it's true, when you're trading, the market is going to tend to move against you a number of times. And unless you get out immediately, you're going to find yourself underwater to the tune of a few $100s. Even if you think that the market is making a temporary move against the grain or against the way that you feel it should trade, remember, the market's always right, but still in all, there are times where the market should hit a target. Now, what do I mean by hitting a target? Now, on Friday, August 4th, the market opened right over here, 45.38 at 9:30. 45.38 is where the market opened. But look, the previous close was at 45.20. That was the gap. So an 18-point gap. Nice gap, okay? Now, if you hopped on immediately, the prices did move. Let's see, there are 5 points between each horizontal line on this chart. The prices moved down about 4 points and then quickly rose and kept going up until they had reached 12 points over the point that they began the day. Now we're at 45.50. Remember, the market opened at 45.38. So we're talking 12 points. The market faded the gap by 12 points. Now, if you played the gap trade immediately, you hopped on and you didn't hop off, you were underwater 12 points. But you saw that what? You saw that the gap was down here. Gaps closed 70-75% of the time. And also, we are in an overbought stochastic. I don't know if you use the stochastic oscillator. I do. The only oscillator I use. And I look for the targets. Now, of course, the most obvious target on this chart is the previous day's close, the gap. So the most likely trade, the highest percentage trade, at least at the open, was the gap trade. And so if you got on right away, you're $600 in the red. Or if you're trading micros, you're $60 in the red. Not too terrible. At $600, it starts to become money. But nevertheless, the market traded up to 45.50 and then, wow, closed the gap down at 45.20. A 30-point trade if you could withstand this 12-point reversal. Or maybe you didn't reverse 12. Maybe it didn't reverse 12 points. Maybe you didn't get on right at the open. You waited till it was here at 45, and it still went against you 5 points. So that's still $250 on the E-mini. But still, in all, the prices started to hesitate up here, and eventually they did come down to the target. Now, it's important to know the targets for the day because the market is going to go wherever it's going to go, but it does have targets. Now, after the market did close the gap right here, reversed and went up. And of course, when it closed the gap, and as I said, I used the stochastic indicated prices were oversold. So it was a relatively low risk trade down over here at 45.20 to get on to the plus side, to the positive side, to go long. And so going long, market went up nicely until about 45, 43, and then started to wiggle. And if you got the gap trade, even with a 5 to 10 point drawdown over here, you got a 30-point gap trade and maybe another 20 points coming back. That would be a fantastic day in anyone's book. But still in all, these trades are basically obvious. Obvious why? Because there was a gap trade here. And even if you didn't get on and you waited 15 minutes until prices did actually move down to the gap, and you waited until you saw prices reverse, you still got the lion's share of this 30-point gap trade. So that's great. If you had the patience, and I always say, use patience when you trade. If you had the patience, knowing that the market generally or often fades the gap in order to fake people out, you wait until the prices start moving toward the gap, and then you get on. And I would suggest getting on with a market order, not a limit order, because as you see, the prices moved very quickly in a momentum trade, in a momentum move in that direction. These are 3-minute candles, by the way. But then when the market hit the gap, you get off because it hit a target. Now, where were the other targets? Don't know. The target could be, well, another target was right down here because we put in a point of support over here, right? Now we have the gap we have this 45.20 gap, and we have that gap that established itself, or prices established, a support area right over here. So then prices went up, and if you got this 20 points on the rebound, reading it right, you probably were done for the day, and you should have been if you got both these trades. Terrific. But I want to know where the targets are for the day, and so I use the Taylor trading zone. And you don't see it on my chart yet. I'm going to put it on my chart in a minute. But I was a little curious on Friday because the market was not trading where it was supposed to. And where was it supposed to? It was supposed to trade where the Taylor calculations told me that the market should trade. And without giving you any further delay, here's where the Taylor trading zone was for Friday, August 4th, right down here. Resistance at 45.25, support at 44.92, okay? So here was where the Taylor calculation said the market should trade. And what happened? The market did trade down there. Didn't happen till later in the day, but look what happened after 2 p.m. After 2 p.m., exactly from the top of the Taylor zone to the bottom. So if you had this Taylor calculator, you would have, in addition to knowing the gap, in addition to knowing that prices are most likely going to reverse after they hit the gap, and now you have another target. You have the Taylor trading zone, which tells you where prices are likely to trade. And so I'm not giving you an explanation of how to use Taylor because that's a longer video. It's more detailed. But knowing where prices are going to look for targets is where you need to have this information. You need to know where the gap is. Very easy. Everyone knows where the gap is. You need to know how to play it. You need to know how, well, I use stochastics. You can use your whatever indicators you want to use. I only use stochastics. The rest of them, I substitute price action. Where are prices going? How are they moving? How are they moving? Because prices generally move in fits and spurts, and they don't give you an indication many times. But Taylor is pretty good at telling you where prices are likely to trade, even when they don't trade anywhere near it. Trade it away from Taylor, and then wow, down into Taylor, right through it. Okay? Having that information on Friday, August 4th was worth another 30 points. So that's my video. Marv Eisen from Timeless Dollar Trading Academy. Thanks so much for watching. Trade safely, use lots of patience, and I'll see you in my next video. And if you'd like to get the Taylor calculator, you can pick it up at my site at timelessdollar.com.